Well, good afternoon, everybody. It's Maynard, Mike, Colin, and Matt. And I know I say it often, but I got to say it today. We have a fantastic, super special, incredible guest to talk with today. We're really excited to get to visit with Francesco La Camera. He's the Director General of the International Renewable Energy Agency. He's been in the climate, sustainability, technology, private sector, public sector discussion for over 30 years. He's had an illustrious career, and we're just so excited. I want to thank Frank Fannin, our good friend, for introducing us to Francesco. But Francesco, let me stop and just say welcome. We're so glad to have you. Thank you for joining us from Rome. This is really fun for us.
Thank you. Thank you very much. It's really a pleasure and honor to be with you. And thanks for name Frank Fannin, that we have been working together in the last years. He's a very good friend. Fantastic.
Well, Francesco, as we get ready to visit with you, let's just do a quick round the horn, guys. Tell me and Francesco and the audience what's been happening this week, what's going on the screen, what's on your mind. Mike Bradley, I'll start with you.
Yeah, Maynard, things look really good right now. Oil's up, natural gas is up a lot on the back of Hurricane Ida and, in what's going on in Europe. But, I'm just going to go ahead and show a few slides here to just kind of walk through what's gone on year to date. Just what I want to show is North American rig count is up about 45% this year, and it's really skewed more towards crude oil versus natural gas. So you could probably say that, natural gas producers have been more disciplined than their oil peers, but both have been pretty disciplined. If you look at the second slide, the oil and gas ratio, given the run up in gas and the gas strip, has really come down as near 3-year type lows. And so that's kind of one of the interesting developments. And, from an energy commodity price standpoint, natural gas has been the big star, as of recently, and the 12-month strip is up pretty high. So you have, currently gas price around $4.70, and the strip is around $4.30, $4.40. So, really, really looks good. Crude oil's up about 40%. The strip's up about 37%. And if you look at there, RBOB is up about 50%, and heating oil's up about 40%. The next one is I think is really interesting is that, people are wondering why has gas moved up so much? And, obviously we have Hurricane Ida and stuff of that nature. But what we're seeing here is, TM1 is Rotterdam coal prices. They're up 70%. FN1, that's UK natty price. It's up 125%. European carbon credits are up 85%. Spain Ford electricity prices are up 230%, and UK Ford electricity prices are up 70%. So, this is interesting because this is really going to start to influence people as they start to talk about, are we going too fast on emissions as, from a 2030 standpoint? And so this is really flowing into what's going on from an inflationary standpoint, at least over there. One of the things that we've been seeing, obviously, lately, if you look at this chart shows natty prompt price versus a UNG ETF, and they've been kind of moving together. This is the strip price right here, and if you look at this red line, this is really the U.S. equities, and what we saw is when equities, when the strip got above 325, 330, there was a decoupling between that and the commodity price. And I just think that just goes to show you that, most, investors are just not buying above what they consider normalized prices. And what this also tells you is that, people that want exposure are moving into the UNG for their exposure. And the reason why that is because the roll is backwardated right now. So you're getting a positive roll, and that's something that hasn't been in the UNG for quite a bit of time. Just from an energy sector standpoint, energy is probably number 4, number 5 in the S&P this year. Year to date, it's about 25%. EMPs are the biggest performers. They're up around 40%. The worst performer has just been refiners and oil majors. Oil majors, as you would imagine, just because of the leverage and the beta there. And if you want to look at, this goes into what we're going to talk a little bit about today, traditional energy versus clean energy. Obviously, XLE is around 26%. And clean energy has done really poorly this year, almost 4,000 to 5,000 basis outperformance. But if you look at those, prior coming to this year, clean energy massively outperformed traditional energy. So traditional energy has really moved up on, crude prices. Now, if you look at the year-to-date performance with E&Ps, the clear standout is this Bakken E&Ps and the Rockies E&Ps. And a lot of that is because some of those companies came out of bankruptcy, and those tended to be some of the better performing stocks. And in the case of sort of the Rockies, Bonanza Creek has been a big consolidator, so that's done really well. And if you look at one of the worst performers this year has been natural gas or Appalachian companies, and that would be kind of counterintuitive given how well natural gas has done this year. And I think one of the reasons for that is that people are using UNG as their alternative for natural gas. And the second thing is a lot of these producers hedged out a lot of their 22 production. So people don't feel like they're going to get the upside by playing those names. And, so that's what's happened in the E&P group. And, we'll go back to oil service. It's done okay this year. The big three, Schlumberger has been the biggest performer. One of the things that stands out too is land drillers have been the best performer, obviously because something we talked about earlier on, the rig count was up around 45%. And offshore service, which tends to have some of the best balance sheet, was the worst performer this year. We think we're going to see more consolidation. We think that's a really interesting group into next year. And so, here's, the midstream companies, obviously, they've done really, really well today. I think unusually well for people. And from a refiner standpoint, it's been a mixed bag. Some of the conclusions, I probably want to make here is that, Europe's storage is low right now. And you saw what I saw, with the coal prices, and that's probably going to stay high probably for the rest of the year. We saw stories today about Russia saying that they're going to refill their storage up. That means Europe is not going to be able to go ahead and get that gas for their storage. So we're probably going to go into winter low in Europe, and so prices are going to stay high. They may come back, but they're going to stay high. U.S., it's the same situation. Low storage, we're probably going to maintain storage, our prices at these levels. And so I think, the one thing that we'd say about E&Ps and energy sector is the first half of this year was all about the commodity prices for crude oil and natural gas going up. And that's obviously, taking these stocks up. I think the second half of the year and into first half 22 is going to be about return of capital. If you look at the E&Ps that we currently cover, I'd say probably 85% of the universe that we cover is going to be below 1.5 times net debt to EBITDA by the end of the year. And so everyone's going to have to lay out the return of capital program. And so we think the valuation gap between crude oil companies and natural gas companies right now, crude oil companies are dialing around $50 crude into the prices and natural gas around $2.60, $2.65. We think normalizes closer to $60 and $3. And so there's a valuation gap, and the way that valuation gap is going to be filled late this year into next year is going to be who does the best job returning to capital. We think there's going to be a lot of that done. We think share repurchases makes the most, the biggest dent is probably the best way of using your cash right now. And the last thing we're going to see is a bunch of consolidation into next year because of where, equities and where free cash flow is. So that's kind of a wrap up of this year. And so we'll just leave it at that. But it's been a great first half. We think second half is going to be good. And we think, into 22 is going to be really, really, really good.
Well, Mike, this will go out on Friday, so people can digest all of that with their Labor Day picnic, I hope. Matt, anything on your mind?
Just wanted to share some work we've been doing on the natural gas, macro, and renewable side of the equation. So as our teams have really spent a lot more time in the renewable complex from a coverage standpoint, we felt like it would be great to also roll that analysis into our natural gas macro forecast and really try to get into an understanding of how renewables and the thermal power complex are interacting with each other. And so one thing that I think is pretty interesting this year, and one of the reasons why natural gas demand has been more resilient than we initially expected heading into the summer, is twofold dynamic here. First, on the wind generation side of things, in July, due to some weather events, we had a pretty significant drop-off. There is seasonality to it. But as you can see in July here, we had a very significant drop-off in wind capacity. And as that occurred, that ultimately caused a greater strain on the thermal complex to run a little bit harder. And in conjunction with a strong weather backdrop, that's really been to the benefit of both natural gas and coal generation. We should see this rebound as we head into the back half of the year. And as a reminder, the wind complex in the U.S. is about 3x the size of the solar complex. So when you get this volatility in the summer time frame, that ultimately puts a lot of pressure on the thermal stack to remain pretty resilient to ultimately end up meeting the power needs. The second thing we've been seeing, which has been impacting positively natural gas pricing in regions like the PGE market, has been the fact that hydro generation has been under a lot of pressure for the last 2 years. So as you can see on the right-hand side of this chart, we've actually had a 2-year decline in hydro generation capacity, and that's also putting some pressure on the system to continue to run pretty strong thermal output. We actually saw some announcements over the last few weeks where California is looking to build some gas peakers in the short term to help out the power stack here over the next few years. So we do think what's interesting about the broader renewable complex, which we're quite bullish on, and we do expect significant capacity expansion over the next 4 to 5 years, our key takeaway from the work that we continue to do is while we continue to believe coal retirements are going to accelerate and that ultimately is going to be a detriment to coal demand, we think natural gas is going to play a bridge fuel here for the foreseeable future. And I think that's going to be a positive from a demand perspective over the next 5 to 10 years in the U.S. In terms of the commodity, we remain constructive on the winter backdrop. Originally, when we came out with our forecast in January, we were expecting the winter to trade towards $4 an MCF. What we've seen is actually the commodities moved a bit higher than that, and the primary driver is some of those moving pieces on the renewable complex, which has helped overall storage numbers, as well as stronger weather during the summer, which has also helped the pull down in our storage estimates. So right now, we're expecting to enter winter at about 3.4 to 3.5 TCF of storage. That's well below what we've seen over the last few years at 4.1. And at the moment, we're expecting to exit winter at about 1.3 TCF versus the historical 5-year average of about 1.8. What that really means is during the wintertime, if we get a cold snap, gas could go quite a bit higher from where we're trading today. A lot of clients we're talking to are setting up for a trade where natural gas could hit $5 or $6 an MCF. Given how strong the global market is from a pricing perspective on JKM and TTF, which is currently trading at $17 or $18 an MCF, and as we head into the winter, those prices could move higher. There's really not a price point in the U.S. where we think we would effectively cut off LNG exports. So the natural gas setup here into the winter is actually stronger than what we initially forecasted, and we would look to remain long the commodity for the winter trade. On 2022, we're still expecting gas to be at least $3.50 an MCF. The curve has kind of moved towards our 2022 forecast. But from an equity standpoint, the equities do look attractive. We actually upgraded Antero about 10 days ago. The stock had a nice run off that. But we continue to expect, as Mike mentioned, some of these names that have under-levered balance sheets heading into 2022, able to return a significant amount of capital back to shareholders, should benefit from the backdrop here of a strong commodity in the 2022 timeframe. And ultimately, that's just going to lead to higher returns, less leverage in the system, and better equity performance. And that's kind of how we're positioned at the moment from a commodity standpoint, as well as an equity standpoint.
This week, I've got a couple of comments on global markets. In addition to the U.S. landfalls of Hurricanes Henri and Ida this past week, a J-storm also threatened global markets. It was a financial hurricane, and its name was J from Jackson Hole. Now, fortunately, Chairman Jay Powell, the central bankers and global markets, dodged the risks inherent in that conference's discussion of uneven growth. The chairman threaded the needle skillfully. He signaled the Fed will start tapering its $120 billion in monthly bond purchases this year, but rate hikes will not happen anytime soon. He acknowledged the reality of inflation in the physical economy, but maintained the opinion that it is not yet a sufficient threat to accelerate the normalization pace of policy. Now, this implicit tolerance of asset price inflation was warmly welcomed in equities, as Mike described. They continue to mark new, if richly priced highs, especially in the technology sector. 2 data points. The S&P 500 is now trading at 27 times trailing 12-month earnings and 20 times 2022 estimates. The Russell 2000 Technology Index is trading at 102 times trailing 12 months and 30 times 2022 estimates. Now, in addition to all the obvious problems with those numbers, there are 2 others that we think merit mentioning. The first is binary thinking. We continue to see this either-or mentality among policymakers, both political leaders and monetary leaders, and that's a bit disconcerting. Many of these challenges are just far more complex than that, and any kind of linear thinking is not helpful. We also see narrow specification of the moving parts. Going back to Jay Powell, his comments focused almost entirely on the pandemic's effects. No discussion of the effects of lockdown policy, no discussion of money creation, really, and the cost benefits therein. And so one stat that you should know about is the US M2 year-on-year growth rate, while down by more than half from its February peak, is still growing at more than 12% year over year. And that's now against a base that was already elevated by emergency measures, including the massive spending programs that we've seen on the fiscal side. Now, it's true, the velocity of M2 is still close to a 60-year low, specifically 1.12 on the multiplier in June of 2021, and that's in a 20-year downtrend. But that's all the more reason to be wary of the potential for unexpected reversal in what, of course, are very long life cycles in fixed income markets. Then quickly, three other items. The OIS market, overnight index swaps, loved Jay Powell's speech. But bond traders really should not lose sight of the big picture. The 2-year USD OIS rate, while it was down 3 basis points after Powell's speech. It's now at 20 basis points. The trend, looking further back to the recovery from the COVID experience, is strongly up. 100 basis points is the primary target. That would get us back to where we were just before COVID. And that's still 80 basis points away. And those could be 80 very painful basis points if they happened in a very short period of time. Turning over to the aluminum market, LME cash is now above $26.95 per metric ton. That's the highest level in a decade. And the US Midwest physical premium is now above 35 cents per pound on all of these strained supply chains. Recall that back in 2014, when that price went above 20 cents per pound, there was all sorts of accusations of what was happening in the market. Of course, what was really happening was the transportation costs from the Mideast into the Midwest of the United States is not zero. And so sending those supplies from Oman, Dubai, and so on involves a not trivial oceanic voyage. And then finally, the guys both mentioned CO2 allowance prices in Europe. Super important. The ICE European CO2 MO1 price breached 60 euros per metric ton for the first time ever on Tuesday. That is now at 61.48 euros per ton, and that's the dollar equivalent of almost $73 per ton. Forward curve remains in contango. T's 25 is now at the equivalent of $76.51 per ton. And as both Mike and Matt mentioned, what's driving that is just this huge demand for natural gas, giving us deficit markets, calling on coal as the alternative. And of course, the generators have to purchase allowances to emit those CO2 emissions. Back to you, Maynard.
All right. Wow. Well, Francesco, you just got a big dose of us. What I would observe, everybody's so excited about Francesco Day. Everybody brought their best data, their best observations. We all got excited. But seriously, it's such a pleasure to have you. And you have been doing this, which is energy and the climate and technology and working internationally for so long. We're just thrilled to have you, and thought we might start by just asking you to talk a little bit about your career and about what you guys do at IRENA, the International Renewable Energy Agency. We would just love to start learning, and again, so happy to have you.
It's really my pleasure, and it's a really pleasure to be with all of you, and thank you very much for all this insightful presentation. I've started working in the Ministry for Economy too many years now ago, and there we developed a methodology for deciding on funding the public projects, and then I went working on projects related to the environment, and then I started to work on environmental impact assessment, building the methodology for our country. And then it was quite natural going to work for sustainable development. Sustainable development means that you must go for a cleaner energy system, so the interest for the energy system. And then lastly, this new adventure at IRENA, and looking at the data and the information you provide always is important that I make clear that I look at all this number from the point of view of an international organization that is intergovernmental, We are now 166 members. It means it's the same members of the United Nations. So we look at different phases of this period. And when we talk about energy, we need to link energy with the climate crisis and see not only the short-term period, but looking at the long-term period and see what's happening. And our work is to support government in assessing their potential on renewable energy, in working on policies, planning. We have also a facility that we have been building with the Abu Dhabi Development Fund. We are building a new one. We launched the Climate Investment Platform that is open for public and private, and we will start next year when the pandemic hopefully will slow down to have investment forum in all our 14 cluster. And I think something is important for the people that is following your program. It is open to the private that want to invest in your country, but so in their own country, but they want also to invest around the world. And we're trying to provide the analytical framework for sending clear message on where the priority are. My last product, and then I go back to you so that I can respond to your question, is the World Energy Transition Outlook, where we try to build a pathway that is consistent with maintaining the raising of the temperature under the 1.5, that is the political target of the moment.
So, well, thank you. One question, and Francesco, because I know you're very involved with a lot of organizations, like I'll pick one, like the World Bank. So you see the energy and climate debate, but you also see the economic development debate. And do you mind? And I know you're working all over the world. I think that's something all of us instinctively wonder about. Is we think power is a good thing. Getting more people power is a good thing. Obviously, the cheaper it is, the more you can get it. You can get it to more people. How is the developing world and those development agencies? What is it like to spend time with them talking about the energy transition? Because that's where it seems to get complicated, is the debate of power versus the environment.
Yeah, you know that the main question that I've seen along the years, especially when I was working on the Italian corporation side, is that there was a consistent framework that was in some way guiding the investment choices, not only of the World Bank, but all the financial institutions. It seems now that this is changing. It is changing rapidly. We know from the International Energy and Financial Analysis Institutes that now more than 100 bank and multi-financial institutions say no anymore to coal. We have seen the G7 say they are not going to fund the overseas coal from this year. So we know that now the messages that the financial and economic world and the political world is sending is clear. And this may support the efforts on providing power to electricity to a large part of people. You know, in Africa is still a number that's too high to be accepted. 800 million people without electricity is not acceptable. And you know now that the off-grid, the mini-grid, and the renewables can play a very important role on this aspect. And also the financial institutions are also taking care of one aspect, that now the most efficient, so the cheapest way to produce power, electricity, is renewable. And this is showing this trend now becoming a long-term trend as the installed capacity. We have seen how the installed capacity has been always the renewable installed capacity be more than traditional one. The last year, 80% of installed capacity was renewable. last year 50 more installed capacity than the previous year, and we are in the year of the pandemic. And we see that the installed capacity of traditional are going down. So now there is a more consistent, a clear path to follow, and this will facilitate also the choices of the World Bank and other financial institutions. A clear sign, for example, is the World Bank is part of our climate investment platform, and we are working to try to find a way to work more efficiently, especially in the least developed world.
So, Francesco, I have a question to follow up on that investment. But first of all, I just want to thank you for the platform that you've helped create. The data and all of this information is super helpful. And to provide it for free to all of us is super valuable. So thank you to you and your team for that. My question on the investment side is, IRENA says the world needs to spend $131 trillion on the energy transition by 2050 to leap through a window that's closing fast. And that's an average of $4.5 trillion per year, or about 5% of global GDP this year in 2021, to build out those almost 28,000 gigawatts of new electricity capacity so that renewables account for 90% of global supply in 2050. So that's the ambition. Here's the question. That forecast implies a truly massive amount of open earth mining. And those will all require environmental impact assessments. A lot of it will take place in Africa, as you just described, where we need a lot of that power, and not only to plant the power there, but also to take the metals and build the plants elsewhere in the world. And given that those assessments have not really been started, the normal timetable would delay the availability of lithium, nickel, copper, aluminum, and the other metal feedstocks to achieve that timetable. So that's the dilemma. How does IRENA advise that we think about the environmental impact studies that need to be done? Do we skip them? Do we accelerate them? How does it affect the timing of what you see to be, the objective of when this is all going to happen?
Yes, thanks for the question. And to look at the initial numbers, or about the investments and the massive investment we need in the energy transition, but that investment is still the 25% of the total investment per year. So it's a huge amount, but just a way to redirect the investment that happen every year. So we are talking about 25%. If we look at the European Union, they commit for 35% of investment in transition on the total. So it's a number that is big, but it's possible. But the second part of your question, I think, is more relevant, because I understand that there is this. We have started to work on mineral and rare earth already with the previous U.S. administration, and I see that this interest on mineral and rare earth is also in the new administration, and we are working on that. We will come by the end of the year with a report on this. Because we think that we have always to distinguish between the short term and the middle long term. So now we have a kind of warming up of the sector because of this enormous demand. Because investors are going for renewables, so they are trying to have all the mineral and material that they need. So there is. And if you look at the trend of this, the price of this mineral, we see that in the long term we have seen going up, going down, going up, going down. So it depends how is the capacity of the market, of the supply to adapt. So we don't think that they are geological rare, and we think that supply can adapt to the demand. The main question we see is that we have to provide for this exploitment for this mineral earth to happening in the respect of human value. So the social aspects are important. The fact that the young people can be put in the mine. So there are many social aspects that are important to consider, so that we can have a sustainable way to produce this mineral and use the rare earth. So to summarize, we don't see this as a major problem for the development of renewables. Naturally, it's also important that we couple this with more effort on circular economy, because all these materials can be reused if we recycle correctly. And we see, for example, some interesting aspect in China where they have a huge way to reuse batteries and other. And we hope that these technologies can be also need investment in other parts of the world. I think that the Europe, US can work on circular economy to reduce, in fact, the net demand for this mineral and rare earths. But hopefully this report that will come on for the end of the year, we can put this kind of clarity on this area, as the work that we are conducting on the geopolitics of the energy transition. We will come with a first report during our General Assembly that will take place second week of January next year. And then we will start with considering the geopolitical aspect of the grid of the hydrogen, of the development of hydrogen. So these are important steps, and I'm sure that this initial contact that we have, thanks to this video call with podcast, may continue. The people that is following your nets can also join the work of Arena, and we can find a way to communicate also between us in a more continuous way. We are really open to work with everyone on energy, on clean energy.
Maybe a follow-on question. One of the reasons we're so constructive on the outlook for wind and solar generation is the cost curve has come down significantly, and on a standalone basis, it is very competitive with a thermal stack. One of the questions that we get most frequently from investors is, broadly speaking, on a planning perspective, how do you think about the intermittency of renewables and storage? Because one of the things that is obviously kicked up here from a conversation perspective is, as we have a larger component of the renewable stack in the mix, that intermittency does create volatility on power generation. And so I'm just curious how your organization thinks about long-term solutions for storage of power, potentially any views around transmission, and then ultimately how we work in that intermittency conversation with reliability of the power complex.
Matt, when I want to be provocative on this, I always say, well, 50 years ago, we have been able to go to the moon. Do you think that we'll be able to manage a system where flexibility, interconnectivity, storage through battery, storage through hydro, can be using also the electric vehicle in this, so that we can work and make a system, a new system that will work? I think it's possible. Artificial intelligence is key in this aspect, and I should say that the US can really lead on this. So it's possible to work on this, as I say, to storage, hydro, interconnection, flexibility. All this is possible, and naturally, the public has to play an important role for building an intelligent network. And I see that this is happening. I see that, for example, in the Europe, a good part of the money of the recovery fund is going for building this infrastructure, ensuring the interconnectivity, and provide flexibility for the system, looking at storage. There is also the new move to the hydrogen, play the double role of be a Korea, but also to be a way to storage energy. So we are going to work on a system that will be more distributed. It's not the old system that was a little bit more centralized. In some way, we can use a more democratic system, energy system, but we are going where we will get there. I don't think this is really difficult very much. It's something that will happen. We have the instrument, we have the capacity.
Francesco, thanks for those questions, guys. I guess one thing that you've been involved with quite a lot in your career is the COP meetings. Whether it's Paris, which was obviously a really big one, or now we have Glasgow coming. Would you mind talking a little bit about, for those of us we don't have direct experience with those gatherings. Like, what do you think? What's your forecast for Glasgow? What will it be like? Biden has obviously come out stronger, much stronger than the previous administration around a lot of these issues. He now has call it some baggage of the Afghanistan, situation. That's something that Frank Fannon was talking about last week. But what's your forecast for Glasgow? What'll happen? What might not happen? What are the issues? What are the things to watch?
What I really hope so we built a new way to have this COP. When I first starting to work on this COP, I thought there was a strange group of people that they were used to work in the night for negotiating a war thing in another. So there was a negotiating mood that was pervasive of the way the COP were conducted. But now we have the Paris Agreement, and we had also, with the COP in Poland, we have the rule book. So the COP, they need to abandon the negotiating mood. They have to look on the way we are implementing the Paris Agreement, having the private into the COP to understand where we are doing well, where we are doing not well, how we can improve. So we have to change the way the COP has conducted, not to judge the success or no success of the COP because the document has been agreed or not. The COP will become useful if they will identify how we can work better together among the government and among the government and private to get the goal of the Paris Agreement achieved. So what I really hope that from that COP, there will be a change of work around this annual gathering. I don't know if I have been clear on this matter.
No, I think you did. I mean, who are really the to that end? So if I was listening to you, stop like a negotiation and it's not a trade meeting and make it more of a, hey, we're all working together. What's working, what's not? Kind of a conference of people, trying for the common good. Who's most able to influence that meeting? Like who really can set the tone one way or the other, or who can take it to something as productive as possible? Is there a particular individual that has that influence?
Traditionally, if you look at the COP before Paris, US, European Union, G77, China. These are the main actors. Now I think we can add India, Indonesia. These are the main actors and naturally the African country, because the developed world is asking naturally always for more support, more money, and this kind of things. So it's very important, and I think that the new administration, together with the European Union, and I am also thinking that China has to get something for climate from their point, also from their own interest. So possibly these people is the people that may drive the COP to be more, more closer to the ground. That I think these are the people. Naturally, UK is trying to play the best their role as a presidency. They want to reaffirm as the international role after they left the European Union. So they are also relevant in conducting the COP and making the move to this new way to work. It's the way we are conducting our General Assembly, Maynard. I hope that you can be part of this gathering where you can see where we're trying to put people discussing concretely on what can be done to do better.
So just one question, I think Colin's going to jump in here too with one, but when you were talking about, let's get together and let's talk about what's working, what's not, I think as analytical and financial people, we're always watching this conversation on the energy transition and wondering when sort of return on investment or cost benefit analysis, when does it become a bigger part of this discussion? Meaning, if we spend $1 billion, what did we get? And when we spend $1 billion and we get a lot, that's better than spending $1 billion and not getting a lot. So do you see that type of thinking entering the discussion? Because sometimes it feels like if you say that, you're, that's sort of viewed with skepticism, like you're trying to slow down the process or something like that. But we are going to spend a lot of money, and it seems like we should be thinking like that. But what do you think about that type of thinking?
Maynard, I start to think that you are a reader of our paper because that's this is exactly one of the aspects that we are pushing. So I think we are taking a leading role on assessing the socioeconomic impact of the energy transition. So we are trying to show through analysis what could be going for the energy transition in terms of return. So economic returns, so cost benefit analysis, in terms of jobs. I think our analysis on jobs are the most welcome globally. Now we are very close to reaching an agreement with the International Labour Organization that recognize the work we are doing on jobs, but also socioeconomic. We have all the estimates in terms of the GDP when we talk about all the aspects of economics. So this is possibly one of the main pillars. So we have the technology area, we have the socioeconomic area that are the two pillars of our analysis. This opening to the private, trying to make all actors working together.
Francesco, another question that
this complete. Sorry.
Please, you go.
May I have the 15 seconds to say that what we have trying to be part of the report of the UN Secretary General to the high-level dialogue. This way to look at things that I hope that will be reflected in this, as we are trying to work on all the other to try to make clear. Also, where there is some resistance to the energy transition, showing by numbers, by through analysis, the advantage of going for energy transition, I think is relevant more than all the dismission that we are assisting from the fossil fuel world. The fact that where there is a transit, we know what we are living, we know where we are going to get. So people sometimes have a skepticism that they are going to be better. So we have to try to show in our analysis, naturally always saying the truth, where we can go and what could be the advantage of the transition. Sorry for being too long. Sorry.
No, that's great. Another question that investors often ask is about nuclear. Nuclear is emission-free and it's energy dense, so it doesn't require as much land and water and even air as other potential solutions. Yet the IRENA forecast puts nuclear at just 4% of the global mix in 2050. That's even lower than natural gas at 6%. How do you think about nuclear, and is there any pathway in the future where even a renewables-oriented agency might find a larger share advisable for nuclear?
Considering the number, I think that we give a little bit more to gas, a little less to nuclear. But I can respond to you that in our statute, so the founder of the agency say that nuclear was not renewable a form of producing energy. So we are not dealing with nuclear. But I don't want to respond to you in this way. But I just want to say that energy produced with renewables in the UAE, where our quarter is based, cost 10 times less than the same amount of energy if produced by nuclear in the UK. So we are not talking about 10%. 20%. We are talking about 1 to 10. So without entering in any kind of a discussion that could be more ethical, environmental or other, and just stick on the cost. We have
by cost, you mean the operating costs, not the full cycle cost of acquiring the metals and the transportation costs and all that, just operating the plants.
Yeah, no, that's when we talk about also on transport, for example, this will make anyway shortly. I don't want to mention the network that say, for example, just to give you an example how the numbers change. They were saying last summer that green hydrogen was going to be competitive in 2050. We come with a paper showing at the end of the last year that green hydrogen was going to be competitive in 2030. Now the companies say that green hydrogen is going to be competitive in 2025, and they are already starting to sell ammonia around the world. This, for example, is coming from the UAE, the last, I think, to South Korea. So on this is changing rapidly. And I think that hydrogen can help a future system to work in a clear way. And, on nuclear, what you say is how we see that. I don't think that the investors may start an adventure. They don't know when the adventure will end. And also there is an aspect that I think I want to mention, already trying to put aside any kind of ethical reason, is that if we want to be in line with the Paris Agreement, all has agreed that the next 10 years are key. So if we don't get the result we should get in 2030, we will never get the 2050 goal be achieved. And if start today to think about building a nuclear plant, the nuclear plant will be there in distributing energy not before 12, 50 years if you're lucky. So it's out of the context. It's not serving the cause of fighting climate change. That is the key reasoning of politicians today.
I think, Francesco, where we get discouraged is when we see, just on this nuclear thing, is when we see people closing down existing nuclear plants. So they're installed and they're creating, emission-free energy, like the one north of New York City powers, I can't remember the percentage, it's a huge percent of New York City, and it's zero emissions energy, and we can't understand why you would shut that down. But that's for another day. That's for the nuclear show. Maybe I could ask you one question, which is, I have a good friend who's in the power business, and we were having a catch up, and he was saying exactly what you were saying, which is, the incredible cost advantage that renewables can have. But what he was pointing out was, he was like, it's so interesting to run a power company because sometimes with wind, for instance, the power is so cheap that it's cheaper than anything available, right? It's the cheapest thing possible. So we, as the power company, why would we own a natural gas facility compared to that? But then he says, but the problem, of course, is when the wind is blowing, it's the cheapest thing in the world. And when it's not blowing, I have no power. So his comment was, the interesting thing about renewables is they're so cheap when they're running, it makes no sense to invest in anything else. And then when they stop running, you have no backup. So this always gets to natural gas and what you think about natural gas as a backup. That's a question we're always asking.
I think this point is very similar to the point that Matt made before. So we don't think that they stop running. In a sense, if we ensure that the system has enough interconnection, enough stability, they will never stop running. So the problem, if we have the proper storage, so if we build the system in this logic, they will never stop working.
So this is will solve the battery problem, solve the transmission problem, et cetera, is what you mean by that.
The price of batteries, man, they are going down impressively. Or see the price of renewables, see the price of hydrogen. All they are going down very rapidly. So what is important is that the politics give the necessary infrastructure for ensuring that the new world can work in an efficient way. So this is important in my point of view. So there is no problem of shortage. Look at the pandemic. No, everywhere, in all over the world, renewables has been resilient. The others not. So the problem was also there was the legend that renewables can have this problem of intermittency, but until a certain threshold, they don't have any problem. Naturally, if you are going towards 100%, is another aspect. But again, we think that artificial intelligence, flexibility, interconnectivity, storage, batteries, hydro storage, and others, hydrogen can be all the instruments that we have for making this world we're working without any kind of problem of intermittency.
So maybe one more question, because we'll confess we're big natural gas fans here, and you mentioned like the nuclear issue of how could you possibly get nuclear online fast enough to do something about 2030, and you kind of went through that logic. I think a lot of us in the natural gas world wonder, why aren't we moving rapidly to replace coal with natural gas every possible place, because it has such an immediate impact. It might not be the 2040 solution, but it is a right away, viable, seemingly a way to cut emissions. What do you think about that?
So naturally, why we need this transition? If we have to substitute coal, we can substitute coal with the cheapest way to produce energy, that is renewables. But anyway, in our scenario, we recognize that gas will lower down less rapidly. Most probably will go coal, then oil, and gas will stay a little bit longer with us. And we also think that gas could be used to produce blue hydrogen. We still have an assessment that 30% of hydrogen will be blue in 2050. So this gives also a chance for gas in certain market, in certain reality. Blue hydrogen could be a good way. So gas plus CCS could be a good way, an economical way to produce energy. So there is an horizon for gas that still it has to go down, but it will go down much less rapidly than coal first, oil second, and later gas.
So this has been so much fun. I think all of us have like 10 more questions we would love to ask you, but you have to. It's evening in Rome. You've got to go to dinner. One thing I was struck by this in the lead-in, right?
COVID, yes, I'm still the COVID minors, so we're staying the family still.
Well, I was noticing in the lead-in, and this happens every week, there's so many moving pieces. There's so many dislocations. There's so many changes going on. How do you keep track of all that? And how do you try to you personally and your organization try to monitor the trends? And what are you looking for? What are you concerned about? Like when you look at the data, what are the 2 or 3 things you're most keyed in on? Because there's so much disruption going on, it can be dizzying, to try to monitor the world and ask, are we going in the right direction?
Yeah, that's true. Just to give you an idea, we monitor more than 17,000 projects per year. Just to give you an idea of our capacity of monitoring. So we have our statistics, as I think you mentioned at the beginning, or I think was Colin talked about that, really provide a very good basis of information. So naturally, we are trying to follow up on all of this kind of thing. What is important also for us that we have a direct access to the Ministry of Energy in all countries. So we can we have built what we call collaborative framework on all important areas. So where we have governments, where we have private, and we have arena. And I strongly encourage you, your organization, your companies to action. We have the Coalition for Action, where we have many companies together with NGOs, governments working together. So we have many instruments that can be used to try to assess and monitoring what's happening. And we have our report, our factual report, the World Energy Transition Outlook. We are going to have this regional. So we are building 14 regional energy transition outlook in the years to come. For the big countries, we are also looking for domestic, like India, Indonesia. So we are trying to make the investors having better quality data. Sometimes I don't want to see use some honest data that can make them to make their choice. What is important that the organization is absolutely neutral. A high degree of integrity is part of our work. So I really love to work with everyone, and I'm enjoying our conversation, and I hope that this can continue in the month to come.
Well, I saw Matt's eyes were lighting up when you were talking about all that data, and so if our organizations can work together and compare notes and share data, we'd love to do it. It'd be an honor. Maybe one last question. CO2, carbon capture, those technologies, we're talking quite a lot about them. They're pretty exciting. So how do you see that fitting in? Are you excited about them? What do you see? What do you see as the outlook there?
So CCUS, Norway is no economical. Always all the experience CCUS, they failed. CCS could be interesting for hydrogen, for gas for producing blue hydrogen. So CCUS, I don't see any future. CCS may have in this particular area an important role. Naturally, there are technologies, new technologies as air capture. They are developing. They are still not economical, but they are working in many parts of the world to get some solution for capturing directly the CO2 from here. I've been clear, Marner? So no CCUS.
Yeah, no, that was a pretty definitive view.
CCS, yes, but and techniques for air capture.
Well, look, you've been very generous with your time. We really appreciate it. I was telling the team before you dialed in, Francesco, that I had an Italian economist friend when I was in grad school, and he would make dinner for all the other Italian economists. And so I know you went to Messina, but I have to ask on behalf of all those Italian economist friends, what's better, Messina or Bocconi? Because they were all Bocconi guys.
This is you cannot put this question. Bocconi could be good. Messina could be nicer.
Okay.
And you can much more excellent food in Messina. You will be closer to my home in Sicily. That's it. It's just 30 kilometers from Messina, in front of the Ionian Highlands. So anyway, Bocconi is a fantastic university.
Well, either way, we want to come visit you, and we want you to come visit us in Houston whenever you can. Absolutely.
If you come, you will have a Parmigiano ready for you, also in Abu Dhabi.
Oh, fantastic. Thank you, Francesco, and thanks to all of you. Really appreciate it.